everybody, welcome back to another episode of Global Fund Voyage, where we help you navigate through the world of investments and market insights. I'm Juliana, and together with me, I have my co-host Daryl.
Yeah, hi, I'm Daryl.
Okay, so today, I think recently we have seen a lot of news after Trump has been elected to office. News about shifting trade policies as well as tariffs. So one of the questions that we all might have will be, what does this mean for the global markets in terms of your interest rates, in terms of inflation? So with all these, we have invited a very special guest, Wei Ming from East Spring Investments, to help us answer the questions above. Wei Ming, maybe a short introduction?
Hi, good morning everyone. I'm Wei Ming from the East Spring Fixed Income team. I'm a fixed income portfolio manager. Good morning, Juliana, Daryl. Thanks for inviting me this morning here to talk about US trade policy and specifically the tariff policy that US administration is thinking about. Someone has once said to me, tariffs is like a failed marriage. They started out with high promises and high hopes, but they ended up paying each other high price. And even wonder why did they actually get into one to begin with. Tariffs policy has been the centerpiece or key aspect of the Trump presidency. Yes, I think on the back of that, the rationale is to protect the US industries and also to reduce the trade deficit that US has been running with many trade partners. But they come with significant and serious consequences. There's been a lot of concern over inflationary impact of such policy, disruption to trade flows, disruption to supply chain. We can talk about implication or impact of such policy.
Sure. Thanks, Wei Ming, for your brief introduction. So maybe first question to yourself, how are tariffs, inflation and interest rates interconnected?
Tariffs, inflation and interest rate are interconnected because when tariffs are being imposed, one of the impact is higher costs. For instance, a company will import raw materials, component, and if they're subject to tariffs, the cost of production will go up, right? I mean, you and I are consumers. We are price taker. So when company faced with this higher cost of production, they will just pass on the cost to consumer like you and I. So we just basically have to take a price taker. We just have to consume it. Obviously, we pay higher price. The alternative is that we switch product, we switch services. Yep. Otherwise, we just have to kind of face with the resultant inflation that we call. And then for the central banks, faced with a rising inflation environment, what would they do? Naturally, they will have to keep rates high or even have to hike rates in some circumstances, right? Obviously, the purpose is to maintain price stability and to combat any inflation pressure that comes through as a result of tariff policies. But on the other hand, high interest rate do attract capital inflow. And that will lead to currency appreciation that will help somewhat offset some of the higher imported price inflation. But overall, tariffs tends to leads to inflation, which will prompt central banks to keep a more tight monetary policy, i.e. higher rates for longer or even hike rates further in that circumstances,
Yeah, maybe on to the next question. I think that was a great understanding and explanation of how tariffs work and why it's concerning. Maybe let's move on to why are we talking about this topic? Why is this topic particularly relevant now?
One of the relevant point at this point in time is because, as you know, US Federal Reserve actually started cutting rate last September. And they have actually cut 100 basis points since then. But with the threat of tariffs lying ahead, I think one of the potential is that easing cycle would be cut short. Why would that be important? Because there will be potential knock-on impact on other central banks if the Fed rate cutting cycle is being cut short or curtailed. This is because many central banks in the world, they tend to follow the Fed's lead. Right? But having said that, where economies are facing weak growth or do not have any inflation problem, I think we could start to see policy divergence. Central banks will start to provide monetary policy support to provide support to the economic growth. But having said that, central banks, especially in EM economies, I think they will track carefully when it comes to easing policy rates in an environment whereby we are faced with higher US interest rate, a stronger dollar. This will avoid excessive currency weakness, which could lead to macro instability.
Thanks, Wei Ming, for your explanation. Maybe next question, I'll ask to Daryl. How do tariffs increase costs for businesses and as well as consumers then?
Yeah, that's a great question, Juliana. So in terms of tariffs, I think I'll split the impacts into both businesses and consumers. So what are tariffs? Tariffs are essentially an additional tax imposed by the government on goods and services imported by the country. So the first impact will be to businesses, right? So for businesses, especially those who are very import dependent, they import a lot of goods and raw materials. So they'll be adversely impacted in terms of their cost of raw materials. So if the businesses cannot translate those rising costs into consumers, they have to absorb the increased costs, and then this affects their profitability. Of course, this poses more supply chain disruptions because if tariffs increase imported goods, businesses might have to import from other sources, other countries, affecting really the global supply chain. Talking about the impact to consumers, right? So when businesses have to import higher cost of materials, they will likely translate these to higher prices for consumers. So consumers will be spending more on the different goods that are imported, and also this means higher inflationary pressure. Of course, I think all in all, increased tariffs, especially with Trump's administration proposing to increase tariffs on Canada, Mexico, China, generally this will increase inflationary pressure on the US consumers.
Maybe my next question to Wei Ming, how do tariffs create ripple effects then across global supply chains?
I think some of this, on this question, I think some of these things we have actually kind of touched on earlier during our conversation. The more immediate impact will be higher costs, we should talk about, whether it be production costs or prices that consumer pay. So this is more the immediate. I think the other ripple effect would be company will start to think about their supply chain management. One is that will seek alternative supply from their supplier to avoid tariffs, to manage costs. The other thing they probably will think about is reconfiguration of their production line, right? Be it reshoring, onshoring, or bringing production facilities closer to their consumer market. But all this would have, in the near term, right? In the near term, it will be difficult to avoid higher costs because all this will take time. And also company have to commit quite a significant amount of investment, capex, right? Which is not going to be easy. So all this will take time. So near term, I think it's quite difficult to avoid higher costs in the near term. As for consumer, I think we talked about, Darren mentioned about, we have to pay higher costs. So I think instead of consuming 3 cups of coffee per day, probably have to cut it down to 1, right? You and I will probably have to go down to Taobao more often to buy cheaper stuff.
I think it's safe to say that consensus that tariffs will actually lead to high inflation, right? So talking about inflation, what role do central banks play in controlling or tapering inflation?
Central bank play a vital role in controlling inflation by utilizing various tools at their disposal. One of which we are quite familiar with, which is interest rate. In an environment whereby there's high growth, high inflation, central bank will bring rates higher. That's hiking interest. We have a hiking interest rate cycle. The other tool that central bank have is by controlling the money supply in the market. And then this could be done through open market operation, buying, selling government securities. That would impact the money supply in the market. Hence, that will have actually impact on the interest rate as well. Setting the reserve requirement of banks, that was also the other tool whereby could affect the money supply in the market again. That would have knock-on impact on lending activities and hence economic activities. And finally, central banks can also use forward guidance, forward communication. That will be able to influence the market expectation of what would be the policy in future, and also kind of at the same that kind of will influence the expectation in terms of inflation going forth. So in summary, central bank will play a crucial role in controlling inflation through adjustment of interest rate, conduct of open market operation, as well as the reserve requirement of banks.
Then Ming, my next question to you. Why do you think persistent inflation will lead to delays in interest rate cuts?
Central bank aims to maintain price stability. If inflation remains high, cutting interest rate could further fuel inflation or inflation expectation, making it harder to maintain, to keep it under control. Importantly, central bank also need to maintain credibility. If they cut interest rate while inflation is high, that will signal that they are not committed to controlling inflation, which can undermine the confidence in their policy. So central bank had to prioritize long-term economic stability over near-term gains. So delaying rate cut helps ensure that inflation is brought under control. Furthermore, monetary policy actually operates with a time lag. The effect of a rate cut takes time to materialize in the economy. So if inflation is persistent, cutting rates too soon may prolong inflation pressure in the system. So in summary, persistent inflation delay rate cuts because central bank prioritize controlling inflation to ensure economic stability and also maintain market expectation.
Yep. So I think in terms of inflation and tariffs, we covered quite a bit of ground on it. But maybe let's talk about the knock-on effects, right? How do these tariffs and inflation affect developed economies in terms of their growth and the market volatility?
I think for the developed economies, generally when you have tariffs policy, one of the impact is going to see faced with slower growth. This is because, as we mentioned, tariffs will increase cost of production, will increase costs for consumers.
Yep.
On both aspects, you look at it, as I mentioned earlier, instead of drinking 3 coffee, you now drink 1, right? Instead of buying 3 new shirts for your Chinese New Year celebration, you buy 1. So what it means that end consumer demand will drop.
Yep.
And if company can't actually provide or else pass on the cost, they will also start to, and we're faced with a slowing demand, right? They will also cut down their capex activity, investment activities. So all in all, you have slower consumption from end user, you have slower investment activity from the companies. And even, right, there's no actual tariffs that is being implemented. The noise of potential tariff policy being rolled out by government, the elevated levels of uncertainty would also keep company cautious in terms of rolling out new investment activities plans.
Right.
So you will start to see investment activities, the level of investment activities start to drop, and that will have knock-on impact on your overall economic activities and overall economic growth.
So Wei Ming, you mentioned earlier about, your previously we discussed about developed economies. Then what about emerging markets? What are challenges that you think they will face?
Okay, one of the potential impact on emerging market is that they will be faced with weaker currency. Tariffs can lead to higher import costs and lower exports. This will potentially widen the current deficit in these emerging economies. This will then put downward pressure on the currency. Also, investor confidence in emerging economies could fall amid this heightened tariff risk or uncertainty, right, which could lead to decrease in foreign direct investment as well as portfolio inflows and subsequent depreciation of the currency. The other potential impact would be capital outflows. With elevated risk aversion among investors, as I mentioned, FDI could fall, portfolio investment will also likely to fall, and subsequently even capital outflow from the financial market of all these EM economies. The other impact would be slower economic growth, just like the developed economies that could face. Because of weaker economic growth, these economies will be more vulnerable to shocks, crisis with weaker economies, because of the weaker economies and also reduced foreign exchange reserve. That will leave the policymaker with less fiscal or less policy space to deal with the emerging crisis.
So I think, Wei Ming, you've covered developed markets, talk about impact on emerging markets. Maybe let's move on to more sectors. Like, what kind of sectors, which sectors, for example, manufacturing, commodities, just a few examples. Which sectors do you think are most affected by these economic forces, especially with relation to what we've discussed so far?
I think some of the most affected sector by tariffs would be your aerospace, defense, automotive, agriculture, technology and electronics manufacturing. Steel and aluminum, because they are really in the direct line of fire in this whole tariff war or trade wars. Main challenges this sector face are really increased production costs that we actually been talking about. This will lead to reduced competitiveness, even disrupt the supply chain. In areas where countries retaliate with counter tariff measures, they will likely also experience reduced export, right? Lower price and economic losses. Example would be like US agriculture sector. So we know that US going to impose quite substantial tariffs on China imports. If China going to take countermeasures, one of the potential sector that's going to be severely affected would be the US agriculture sector, which we actually saw in the last trade war as well.
Then with all the above, I think one question that we all might want to know as an investor or businesses and investors, what are the key data points such as inflation reports and central bank meetings that we should monitor?
I think investors as well as a central bank will probably be watching closely inflation data and also labor market indicator that's going to come over the coming weeks and months. This data will have important implication for central banks. Right? As I mentioned, if inflation data start to show up, there's increased inflation pressure. That would means that central banks would have to be patient in terms of further easing interest rates. But at the same time, some of this tariff policy would also be growth negative. Why? Because we mentioned that higher prices will lead to lower end user demand, and what it all translates into would be your slower economic growth. Right? In that slower growth environment, will we have a weaker labor market? If we do have a weaker labor market, central bank would also have to act to provide support to the growth and also the labor market. So these are the key data that central bank like Fed, US Fed will have to be watching: inflation as well as labor market. Right? If there's a significant weakening of labor market, we expect central banks like the US Fed to come in to provide support by cutting interest rate.
So they'll need to do the balance.
It's a fine balance that they need to maintain
unemployment
and that's why inflation. I think it's not an easy job to be a central bank and in this current environment whereby they face with the potential of higher inflation, but at the same time where the potential also could be seeing a weaker growth, right? Specifically in the labor market, which is kind of one of the mandate that they need to kind of monitor and manage.
I think it's safe to say that with tariffs and inflationary pressure, it's creating a lot of volatility and uncertainty in the markets. My next question is, how are financial markets reacting to these economic trends?
I think it's safe to say that tariff announcement or related news will lead to immediate heightened market volatility we have already seen in the recent days and weeks. Right? Stock market will tend to react the most, or maybe the FX market. We have seen in recent days that any headlines related to potential announcement of tariffs or tariffs, equities reacted to it by selling off quite meaningfully. That's because, especially in market like the US, where valuation arguably is high at this point in time, I think that would be much more sensitive to such negative headline. Right? So heightened volatility, I think that's definitely one of the impact of or reaction to tariff news.
Okay, then what potential policy shifts could significantly alter the current economic landscape?
Well, since tariff policy, potential role of tariff policy is one of the driver of volatile market. Any rollback of that, I think, would also be the same. Obviously, it's going to be in a more positive manner. So any trade deals, any successful negotiation of a trade deal, any rollback of a threat of tariffs, I think that would change the trajectory of the market, even potentially even the trajectory of the future economic growth. The other possible policy action that could alter the landscape would be government undertaking loose fiscal policy, such as increased government spending on infrastructure, on social program, or even tax cut to actually stimulate economic growth. So that would actually help to offset some of the negative growth impact from tariffs policy. Or central bank could also come in to help. Obviously, that we mentioned before, they have to strike a fine balance between providing support to the growth, at the same time managing the inflation pressure that comes through because of the tariff policy. Lastly, I think deregulation can help because deregulation would be able to stimulate or encourage new investments. That would potentially help in terms of creating more jobs, positively influencing the economic growth. So these are some of the potential policy or development that could provide alternative trajectory to what the tariffs alone could create.
Yeah, thanks, Wei Ming. I think we covered a lot of grounds on tariffs, inflationary policies, impacts, central bank policies. So maybe I'll just go to the conclusion, right? If there's anything you want our viewers to take away from this coffee chat, what are the key takeaways that you would suggest investors take away?
I would think that from policymaker perspective, right, I think they need to be careful in terms of to consider the impact of tariffs and what other economic factors or impact all these policy action will actually create, and then make the informed decision, right, to balance out the short-term needs with the long-term goals. Ideally, I think they should come to a point whereby they foster open trade relationship with trade partners, implement the right type of fiscal policy, and obviously at the same time take a vigilant approach towards managing inflation. Right? For businesses, there should be a focus in terms of resilience, adaptability, and diversifying your supply chain. Right?
Yep.
So investing in more innovation and also managing costs more effectively. And for consumers, stay informed of what the economic changes ahead, and most importantly, to make prudent financial decision, right? That would go a long way in terms of helping the consumer to navigate such volatile times that we are likely to face.
Right. Thank you, Wei Ming. Thank you very much for coming down today, for sharing the insights and for sharing with us so much of your knowledge. And as well as thank you, Daryl, for co-hosting today's episode with me. That's it for today's episode of Global Fund Voyage. Till the next episode. In the meantime, don't forget to stay informed and stay invested. Bye.
Bye.